Everyone dreams of a home of their own. If you're watching me today, you've just taken the first step towards realizing your dream. So let's get you ready for homeownership. That's right, finding and financing a home requires preparation. If you're prepared, the process will be easier and go much faster. So before you start shopping for a house or a home loan, you'll want to understand the 3 C's of homeownership: credit, capacity, and commitment. First, let's talk about credit. Most home buyers will need a home loan to swing a purchase as large as a house. To qualify for a home loan, you'll need good credit. Your credit or credit report is a record of how well you've paid for items you've purchased on credit. It's also a record of how you pay your monthly bills. If you don't have a credit history or you have very little credit history, you'll need to establish good credit or improve your credit score to qualify for a home loan. How can you do this? First, pay your bills on time. If you have revolving credit cards, you can improve your credit score by keeping your balances low. Lenders will make decisions about your ability to repay a home loan based on your credit report and credit score. So it's important to be sure your credit record is correct and up to date. Mistakes on your credit report can count against you, and fixing mistakes or repairing damaged credit can be difficult. You should monitor your credit regularly and notify your credit bureau of any mistakes or discrepancies on your report. By law, you are entitled to a free credit report from each of the 3 major credit reporting companies once a year. You can get your reports online by visiting annualcreditreport.com. Annualcreditreport.com is the only official site explicitly directed by federal law to provide credit reports to consumers. It is a free service. Watch out for lookalikes. Other online services may charge you for the same information. We talked about credit. Now let's talk about capacity. Remember the 3 C's: credit, capacity, commitment. Ask yourself, do I have the financial capacity or ability to afford a home and qualify for a home loan? Before you can answer that question, you'll need to understand what costs are commonly associated with a home loan, and more importantly, your own financial condition. Most of us know how much we make each month. Understanding how much we spend requires some homework. Homework in the form of a personal or family budget. Once you begin to add up the numbers, you'll have a better understanding of your capacity or ability to take on the financial responsibilities of homeownership. Your monthly budget is the sum total of all your monthly expenses and should include your current monthly housing costs. Once you have your budget, you can use it to calculate your ability to take on additional monthly expenses, like a home loan, also known as a mortgage. First, use your budget to identify how much you're spending on housing each month. Let's call this your housing expense. Subtract your housing expense from your total budget. What's left will give you a pretty good idea of your ability to afford monthly mortgage payments, homeowners insurance, property taxes, maintenance, and other expenses related to homeownership. Lenders call this capacity. When evaluating your borrowing capacity, lenders will also factor in one-time expenses commonly associated with most home loans. This includes, but may not be limited to, down payments and closing costs. Most lenders will require a cash down payment from you as part of a home loan package. A down payment is the amount of money you spend up front to purchase a home. The amount of your down payment will affect the amount of your monthly mortgage payment and the interest rate you will pay. Typically, the greater the down payment, the lower the interest rate and monthly payment. To qualify for most home loans, you will need 3 to 20% of the sale price of your home in cash for your down payment. If you put down less than 20%, you will have to pay mortgage insurance. Some federally insured loan programs allow lower down payments with lower mortgage insurance rates. Your lender can direct you to these programs. Monthly mortgage payments, homeowners insurance, property taxes, down payments, closing costs, and interest rates. There's a lot to consider when evaluating your borrowing capacity. Luckily, we live in the information age, and you'll find online tools that can help you accurately calculate the costs of homeownership. Once you understand the costs and can gauge your capacity to meet the financial obligations of homeownership, you're ready for a commitment. You'll need to weigh the benefit of homeownership against its costs and the commitment it requires. On the upside, You own the home you live in. You have the security of knowing that, as long as you make your payments on time, you can't be threatened with rent increases or the possibility of eviction. Your monthly payments no longer go to the landlord. Instead, payments help you build wealth over time by increasing your ownership position in your property. The U.S. tax code generally allows homeowners to deduct the mortgage interest from their tax obligations. For many people, mortgage interest represents a huge tax deduction, since interest payments can be the largest component of your mortgage payment in the early years of owning a home. If there's a downside to homeownership, it's the commitment, both financial and personal. Finding, financing, and purchasing your first home will be a life-changing process. It may require you to step out of your comfort zone. If you've been renting, your housing expenses will likely increase. So you'll need to commit to your budget for the long haul. Miss a mortgage payment and you'll damage your credit. Miss too many and you could lose your home. If you're renting and the hot water tank goes out, you call the landlord. The grass is cut and the snow is shoveled by the landlord. When you own your own home, you are the landlord, and you will be responsible for maintenance and upkeep of your home and property. You'll also be responsible for property taxes, homeowners insurance, and monthly mortgage payments. When you're renting, you can pack up and leave when you're ready. When you own, it's not that easy. You're committed. In fact, most homeowners live in their homes on average for 7 years. That's a commitment that can be scary, but to many people, the rewards of homeownership far outweigh the challenges. Are you ready for homeownership? Have you the credit capacity and commitment to take the next step and move forward with your dream? If you answered yes, join me for our next video, Finding and Financing Your New Home.